Good afternoon. Happy Friday, everyone. Welcome back to Earning Keepers. So, it's the 24th of the month, and we're almost to the end. And next month, we will be doing another case study. So, let's do a recap. This is for a 33-year-old mom with 3 kids living in Idaho. We are complementing her financial portfolio, which is heavy on investment and retirement savings. And she only has a high yield savings account as her defensive strategy in her financial plan. So we're boosting her defensive strategy with a permanent life insurance. I'm using an index universal life. So an index universal life is a financial safety net that you can set up for yourself. Remember, we looked at her insurable needs, and she has $450,000 of mortgage that should be paid off in 20 years. She currently has an existing $50,000 worth of debt that she's paying down, and she also wants to set up or secure an educational fund for her kids with $100,000 to begin with. And like I explained before, is mortgage and debt will eventually shift to the education as those items, those insurable needs gets paid down. And those are the temporary financial responsibilities that this client profile has. And eventually, after 20 years, she can drop that coverage. And so she also wants to secure $150,000 for lost income in case she's unable to work for whatever reason. She would have $150,000 of Index Universal Life face value, right? So if she becomes chronic, critical, or terminally ill, then she can tap into that for lost income, or it's going to be her base amount for her IUL policy. And what we did is we split the coverage. We didn't put all the insurable needs that she has into the Index Universal Life face value. We split it to a temporary coverage, and then this is the enduring coverage that she would keep, right? The temporary coverage lasts until 20 years. The enduring coverage, that's the amount of insurance that she would be paying for the rest of her life. And towards the end or the twilight of her policy, we would be reducing the amount of insurance she's paying for by switching into a level death benefit. So in the beginning, we're doing an increasing death benefit, and then here towards the end, we'll switch to a level death benefit. We looked at the cash value, right? Now, the cash value for this particular IUL policy design has fertile ground to grow because the way we structured it, splitting out temporary coverage with enduring coverage, only having the least amount of insurance allowed by the IRS into the IUL face value reduces the costs, right? So if we reduce the cost, more of her premiums, which is $445 per month or $5,340 per year, more of her premiums goes into cash value, allowing the cash value to be able to grow faster, sooner, so that she can stop paying premiums sooner, and her cash value grows so that she would have equity in the total death benefit, right? So even if she drops all this temporary coverage later on and just pays for $150,000 of coverage, her cash value continues to grow and is added on top of this $150,000, making up the total death benefit that will be transferred as a legacy to her beneficiaries when she's no longer here. Her cash value is her ownership, her equity in the death benefit, right? So she's just paying for this smaller amount, and the remaining of her death benefit is made up of her cash value. And that cash value is also her safety net if she will have financial expenses in the future, unplanned or imminent, she can tap into her cash value. We looked at the cash value growth because we were able to drive down the costs, right? If she stops paying premiums 20 years later, she could have 1.1 million by age 90. Or if she continues to fund the policy until age 65, she could have 2.4 million. So give or take, right? It can be higher, it can be lower. depending on the index that she would be using. The index would determine the growth of her cash value. Her cash value is not invested in the market, but it's tracking an index only following the upside. So when there's an upside, credit is put into her cash value. When the index is crashing, it doesn't drag down the cash value with it, right? So look at the cash value, what she can do with the cash value later on in life. How she use the cash value when she's older, right? So the way we set this up, remember she already has a retirement account, right? So in retirement, she could start pulling distributions, her retirement account. Then she could also have Social Security added into that. So she retirement money, and then she has Social Security. Now her value in her Index Universal Life could also be an addition. So for example, when needs long-term care, right? For example, let's say between the ages of 85 to 95, she's with condition that she nursing aid or someone to take care of her, or she has to stay in a nursing facility, right? So how much would she be able to take out from her policy to cover the for long care, right? Okay, so plug that into the illustration. So what we'll do is between the ages of 85 to 95, right? Based on the conservative growth of her cash value, how much will she be able to withdraw annually or out annually? It's not just withdrawal. We can use a combination of a withdrawal and a policy loan, right? How much will she be able to use from her policy to pay for long care, right? So let's run that between the ages of 85, okay, to 95, okay. And what we'll add here is, let's make sure that by age 95 that she would at least have $300,000 of death benefit that will still be transferred to her beneficiaries, right? Okay, so just run. Okay, so what I'm using here is just the basic or vanilla type of Index Universal Life. There's no bells and whistles here, but it is capable of generating a solid cash value reserves, and we would be able to use the cash value in this case for long-term care. So we're setting it up for long-term care. Okay, so let me just capture that, and so I can share with you guys. So right, hopefully you can see. So we're looking at between the ages of 85 to 95. Let me see if I can zoom in, right? So here we can see that she could pull out a total of $137,000, $137,000 from her policy. And by the age of 95, she would still have, we set it so that she would still have $300,000 that would be transferred, $300,000 that would still be here, $321,000 that would be transferred to her beneficiary. So $137,000 tax-free that she can use for paying for long-term care. And this is on top of her retirement, on top of her Social Security, right? And this will take care of her long-term expenses. We can adjust it. Let's say, what if she wants to be able to pass down $500,000 of death benefit to the family? So we just make some adjustments here. We set the final value to $500,000 at age 95, and we run the calculation again. Okay, so the ages of 85 to 95, she would be able to get $106,000 every year to pay for long-term care. And if she passes away at the age of 95, there would still be $521,000 $521,000 will be transferred to her beneficiary. So a good example of usage of the cash value later in life for long-term care, how she's able to use her policy while she's alive, right? So that's living benefits. If we calculate the total amount that she used, so that's 1.2, 1.3 million. If we multiply the $100,000 she takes out every year. Oh, sorry, it's not 106, it's $125,000 every year, right? So sorry about that. Let me just show. It's $125,000 every year from age 85 to 95. So the total of that is 1.2 million that she was able to use while she's alive to pay for long-term care. And on top of that, she still has $500,000 to transfer to her beneficiary. So overall, her total benefit, living and death benefit, is 1.8, roughly $1.8 million. And the total amount premiums that she had paid in was $106,000. Right? From $106,000 benefit with 1.8 million from to $1.8 million of benefit for this policy for the profile. So I hope that information was helpful in understanding Universal Life. Structuring it makes this kind of benefit available for the client, providing that peace of mind, providing that balance in her financial portfolio, allowing her to be able to use her policy while she's alive and still pass on a legacy to the people, to her family that's left. So thanks again for joining me this afternoon. I hope to see you guys again. If you have any questions or if you want to see if this is something that fits in your financial portfolio, don't hesitate to reach out, DM me. I'll leave my information in the description so you can reach out to me. Have a good rest of your day. Have a good weekend. See you guys in the next one.